Welcome everyone to this lease webinar. This is a fourth in a series. This is topic 842, and we're going to be going over practical implementation. So now that we're getting to the point that the entries need to be recorded, we're going to walk you through some examples, go through a template that we've created on how to capture those accounting entries, and just make sure that you're familiar with, what it would look like, what the accounting look like, and what the template that you could use would be. It is going to be hosted by myself, Kristi Humphrey, and I have a guest host with me today, which is Rebecca Brozyna. A few housekeeping items before we get started. One, similar to the other lease webinars, if you participated in them, we will have a Google Form survey that will be sent out to everyone registered following the presentation. If you can, please complete that, as well as capture 2 keywords that we will be, Rebecca and I will both have one that we will deliver during the presentation. Those 2 keywords will be critical to getting any CPE credit that you need. So you will need to capture those keywords and enter them into that Google form. Following this presentation, which is being recorded, so you will be able to go back and review it again. You will also be able to obtain a copy of all the presentation materials, as well as the Excel template that we'll be utilizing throughout this presentation. If CTBK are your auditors, you can reach out to any contacts at CTBK. This is the template that we use as a firm when we are reviewing or accounting for lease standards. Or if you want to reach out directly to me or Rebecca, you can do that through the email addresses that will be on the last slide. If you have any questions, there is an area for Q&A within this webinar, as well as the chat function. We do have individuals that are monitoring the chat and the Q&As. So I may not be able to see them right away, but for those that are monitoring them, if it's something they think it's critical to answer at that point, they will interrupt me and we can talk about it. Otherwise, we will save those questions towards the end of the presentation. Any questions that we don't get to because there's not enough time, or simply we need to do a little bit more research before providing the answers, we can definitely email you back and follow up and answer your questions that way. And as I noted at the end of the slide is my email address. So if you do have any questions, even following this webinar, you will be able to get those addressed by just emailing me directly. And I will follow up and try to get you your answer. And with that, I'm going to turn it over to Rebecca.
Thanks, Kristi. So the topics we're going to cover for you today are a brief overview of topic 842 and the basics of topic 842. Then Kristi is going to take you through a couple of lessee accounting template examples. And then we're going to wrap up by going through the guidance for related party leases and the different options you have when it comes to that. And then, as long as time allows, at the end of the presentation, like Kristi mentioned, we'll go through any questions you may have that you've put in the chat throughout the slides. So starting with a general overview of topic 842, FASB issued ASU 2016-02, which requires a lessee to include all leases extending greater than a 12-month period on the balance sheet. Previously, only capital leases were required to be recorded on the balance sheet. And with this ASU, entities are now required to classify leases as either finance or operating. So finance leases are what we previously referred to as capital leases, and the accounting treatment for those has not changed. Operating leases have historically been accounted for similar to rental payments. And our presentation today is going to cover the practical implementation of the change in accounting treatment for these operating leases. The most significant change is that now entities are required to record a right of use asset and an operating lease liability on their balance sheet for each operating lease obligation. And again, as Kristi mentioned, as today's presentation is more about practical implementation, we're not going to go too in-depth here on the basics. So if you're looking for more information, you can refer to the first 3 webinars that CTBK put on last fall. So moving on to the basics of topic 842 and how to determine if you need to record a right of use asset in operating lease liability. The first question you need to ask is whether there's actually a lease present. This would mean that the right to control the asset has been transferred to the lessee. So in order to answer that question, the lessee needs to consider whether they will be the one deriving the benefits from the use of the asset and whether they are able to direct the use of that asset. So if you consider that and the answer to that first question is a yes, you move on to the next step, which is to ask if there is an identifiable asset. So in the lease, the asset needs to be physically distinct and specifically identified in order for this standard to apply. For instance, in an office or warehouse lease, you will typically see that the address of the space and the specific areas within the building that the lessee has the right to use are identified in detail. So in that case, the asset has been specifically identified and defined. An additional item to consider is if the supplier or lessor has the right to substitute a similar asset without the lessee's consent or approval. You do not have a lease under this standard as the asset was not specifically identified, so you would not adopt topic 842. But if the answer to both of those questions, is there a lease and is there an identifiable asset, is yes, a lease is present and a right of use asset and operating lease liability should be recorded. We're going to go into more detail a little later in the presentation about specifics on how to record the right of use asset and operating lease liability. But right now, we're just going to cover what goes into recording the initial entry at a high level. So the right of use asset is calculated as the lease liability plus any initial direct costs and prepaid lease payments, less any lease incentives incurred. So we're going to discuss the calculation of that first part, the lease liability, on the next slide. So for now, I'm just going to touch on those other items that need to be factored in. First, initial direct costs are any incremental costs of a lease that would not have been incurred if the lease was not executed. For instance, this would include commissions paid or any payments to existing tenants to incentivize them to terminate their lease. This would not include the cost of negotiating and arranging a lease. However, any lease preparation costs incurred after a legally binding commitment has been made may be included in this. Prepaid lease payments are any amount of the scheduled lease payments that were made upfront by the lessee at the very start of the lease. And lease incentives may include a few different things, such as any lump sum payments made by the lessor to the lessee at the date of the execution of the lease, any payments made from the lessor to the lessee to reimburse them for leasehold improvements, and any payments made by the lessor on the lessee's existing lease to entice them to enter into the new lease. So once calculated and recorded, the right of use asset will always be amortized on a straight line basis, despite what the actual cash payments for the lease may be. The operating lease liability is calculated as the present value of the future minimum lease payments, which we're going to get into on the next slide. So how to measure the lease liability? At the adoption date or lease commencement date, the operating lease liability will be equal to the present value of all unpaid lease payments. As a reminder, if you are adopting the new standard for existing leases, this is calculated at the adoption date, regardless of when the lease began. So in most cases, for existing leases, this would have been as of January 1st, 2022. So the first thing to consider is lease payments. This should include any fixed payments stated in the lease agreement and any variable payments that are based on an index or rate. In these cases, you should calculate the payments based on the rate at the commencement date, with no adjustments being made when an index changes. Variable payments that are not based on a rate or index are not included in the calculation of future lease payments and should be recognized in the period incurred. I'm going to get into the discount rate a little further on the next slide, so I'm going to skip over that for now. Skip down to the lease term, which should be the term stated in the lease. So this would include any non-cancelable periods along with any options to extend if the lessee is reasonably certain to exercise that option or if the lessor controls that option. So lastly, the discounts rates available to use. There are a couple different options as far as how you can choose what discount rate to use in the present value calculation. Step one is to determine if there is a rate implicit in the lease agreement. If there is an implicit rate within the lease agreement, you must use that rate. However, if there is no stated rate within the lease, the lessee has two options. First, you may use the lessee's incremental borrowing rate, and this would be the rate of interest a lessee would have to pay to borrow an amount equal to the lease payments over a similar term as the lease term. So lessees may use the interest rate on a secured line of credit, for example, if they use this option. The second option, which is available only to non-public companies, is to use the risk-free rate. In most cases, this would be the treasury bill rate for a period comparable to the lease term. But if the lessee decides to use the risk-free rate, it must be used consistently for all leases. And then lastly, for 2022, which is the first year of implementation, regardless of when a lease term began, the rate used should be the January 1st, 2022 rate for all leases that had started prior to the beginning of this year. But for any leases beginning after January 1st, 2022, the rate used should be the rate as of the beginning of the lease term. So that's just important to look out for specifically this year. And then before I hand it back over to Kristi, your first keyword of the day is going to be cat, because those are my favorite animal. So the first keyword is cat, and then Kristi's going to walk you through a few examples now.
Thanks, Rebecca. So now that we've gone back through the basic understanding of ASC 842, now I'm going to walk you through how do you set up a template? What do those entries look like? So in using a lessee accounting template, there are 4 key steps that you're really going to go through. The first one is going to be capturing your lease terms. The second one is after you've captured those terms, really inputting those terms into that amortization calculator to calculate the present value of the lease payments or that lease liability. Step 3, you're going to build your accounting entries based off that amortization schedule. So once you've done that amortization schedule, you can build what your accounting entries will look like. And step 4 is to make sure you've done some double checks. Make sure your right of use asset, your lease liability amortizes to 0 by the end of the lease payments process. And in the template that I'll walk you through, you will really see that we've kind of built some check balances in there to make sure that it is amortizing to 0. Now, one thing I want to note before I move on is when you're going through this process, I will advise you that step 1 is probably going to be about 75 to 85% of your time in this process. That is where you're going to spend a majority of your time going through your leases and make sure you're capturing all the appropriate lease terms. If you don't capture the right lease terms, the rest of this process is going to produce an answer that may not be right. For example, when your auditors are going to go in and test your lease accounting, they're going to make a selection of those leases, and they're going to go all the way back to the leases just to verify that you've captured the right lease terms. So you do want to make sure you're spending the appropriate amount of time going through your leases to make sure you've captured the right appropriate lease terms. So what are those lease terms that you really need to capture? Here you can see the key ones that we've identified are commencement date, termination date. And keep in mind, this is not just the non-cancelable periods in the lease that would be that termination date, but if you have options to an extend and you are either most likely going to extend as a lessee or the lessor controls that right to extend that lease, you need to include those extension periods in that full lease term. The rate in the lease. So if there is a rate listed in the lease, that is the rate that you must use when calculating your lease liability. So make sure you've double checked your lease to see if there's a rate listed in the lease. Lease incentives. So Rebecca had mentioned a few of those. They may be tenant improvements. They may be, early termination benefits of your old leases, things like that. So make sure you're capturing any of those lease incentives that may be listed within the lease. And then lease payments. So you can see the items in blue on the screen, the key items of the lease payments that you want to capture. Any fixed base rent that you may be paying on a regular basis. In addition, any other fixed rent items, taxes, utilities, CAM. Again, there is availability to group your lease components and non-lease components together. And my recommendation for ease of use, that is probably an easier way to elect. That means all of your fixed rents that are not just base rent lease payments, but your taxes, utilities, and CAM would also be captured in your lease payments. Any variable rent listed in the lease that may be based on an index, the prime rate, the LIBOR rate, anything like that, you want to capture those variable rents. And again, you're going to use that index that was in place as of January 1st, 2022, or if the lease started after January 1st, 2022, the index in place at the time the lease started. And then I've asked you also to capture any variable rent based on other methods, not on an index. You will see later in the template, we are actually not capturing that for calculation of our lease liability, but it doesn't hurt to capture that as a term. So you have all the terms kind of listed there. Step 2, once you have all those terms, you're going to go into an amortization calculator. So you've got to identify your tool of choice. For CTBK, we use T-value software. So that's a software that really will produce an amortization schedule for us based on our inputs. There are free online amortization calculators that you can use. What I've highlighted here in blue is one that I actually found out on the internet. It's a free tool. I put our exact example that I've used through T-value through this tool, and it produced the exact same answer. So that's one key way to make sure that you have the proper online tool, is you can use the example we're going through today in the webinar, put that example into the tool and see if it produces the same calculation. If so, then you know you've captured a tool that will give you all of the same things that a T-value software would provide. Make sure your tool allows you to enter the loan date as well as the first payment date. It also, you need to make sure you can enter the payment schedule, the interest rate, the compound method, the loan date, and at least the first lease payment date. And then when you're going through the tool, the one thing you are going to leave blank is going to be the loan amount. As you can see, my light shut off. It always happens in at least one time during my webinars. And then this tool, once you enter all those factors in, will actually produce a present value of the loan or your lease liability. So now that we've walked through step 1 and step 2, I'm going to walk you through using the template that we use here at CTBK, which we can make available to you. We're going to walk through 3 scenarios today. So I'm going to walk through scenario 1, which is just a basic lease with the same amount of lease payments every month for the full term of the lease. Scenario 1B is going to be very much based off that same scenario 1, except I'm going to add a lease incentive, and I'm going to show you how that changes the accounting just a little bit. And then scenario 2, is going to show you something with escalating lease payments, where the lease payments gradually increase on an annual basis. So they're still monthly payments, but they're going to go up each year until the end of the lease term. So now that we've gone through those scenarios, I'm going to walk you over to the lease template. I have magnified it a little bit so you can kind of read it a little bit better. If you have any problems with reading it, please just put it in the chat function. Somebody monitoring can kind of help me out and let me know to make it a little bit bigger, but hopefully this is big enough because I have increased it quite a bit. So this is a template. We're going to start with the basic lease. So same lease payments every month for the full lease term. You can see in my template, everything that I've noted in blue is coming from the lease. So these are my lease terms that I've captured. So for this particular lease from, the lessor is company happy, the lessee is company fund. My commencement date was January 1st of 2020. So this is a lease that has been in place for 2 years. My termination date with the lease is December 31st of 2025. My lease rate. So in this case, when I pulled from the lease terms, I had a lease rate that was given to me in the lease. And that rate was 2% over the prime rate. In this first scenario, I had no lease incentives listed. And then my lease payments, which you can see I've identified below, are on a monthly basis. So let's go through those. So I've identified here the periods of all the lease payments. Keep in mind what I've done in this example template is I've listed all the periods, even the ones that have happened in the past already. I wanted to make sure that I'm capturing all the lease terms. So I started with the beginning of the lease, January 1, 2020, and went all the way through December 1st, because my payments are made on the 1st. So my contract's through December 31st, 2025. I've captured my first one, which are my base rent. So that is my fixed monthly rent of $50,000 every month, and it doesn't change through the lease term. I've secondly captured all my other fixed payments. So this is my utilities, my CAM, anything else that might be in those fixed amounts. In this case, my lease was an extra $5,000 a month fixed. In my leased example, I have no rent that is variable based on an index. I have a column captured here to capture that, but I have none, so I haven't listed any. And then I've also listed a column for any rent that is variable, not based on an index. Now, one thing I want to point out is if you look at the formula of my 55,000, it really captures column C, which is my base rent, my fixed payments, my 5,000 a month, and my variable based on an index. This total consideration does not include any variable not based on an index. And for purposes of just a reminder to myself, I noted here that these two, even though I wanted to list them, will not be used because my implementation date is going to be January 1st of 2022. So I'm going to go down here, and you can see in my pink section, in my yellow section, these are the items that I've now inputted into my online amortization tool or T-Value if you're using T-Value software. So in this case, I compounded, my compound period is monthly because I'm making monthly rent payments. My interest rate, remember up above, my interest rate was 2% over prime. So how do I know which prime rate to use? As we've mentioned a few times throughout, I'm going to use the prime rate as of the date of implementation. So January 1st of 2022, which at that time, it was 3.25. So 2% on the 3.25 is my 5.25. So that is the interest rate I'm entering into my software. I'm going to enter my first event is my loan. My loan is going to start on my implementation date, January 1st of 2022. And this amount is always going to be your unknown. That's what you're solving for. You're solving for that present value of that loan. Then I enter each of my payments. So my first one is my payment starting on January 1st. There's my 55,000. As you can see from right up above here, my 55,000. And I have 12 monthly payments of 55,000, which will end on 12/1/2022, so that my next one starts in January 1st of 2023. So I enter that for all my payments, making sure that my start and end date, I've captured all payments. When I enter all of that, my tool will provide me my loan amount, which in this case is the present value, or $2,386,955.48. If I go over here to in the purple section, you can see that now I've captured my lease liability. That is my lease liability, that present value of those loan payments. To calculate my right of use asset, I start with my lease liability and I look at any lease incentives, initial direct costs. In this case, for the simple basic one, we have no differences. So my right of use asset will equal my lease liability. Go back over here. You can see in my template, I've entered the amortization schedule right over here on my left-hand side. This produces my payment. My payments being $55,000 and my interest and my principal and my total balance. And I've entered the full amortization schedule all the way down to the bottom. Over to the right in green, I have captured for you my accounting entries. So let's review these accounting entries. My lease expense. If you recall in the beginning of the presentation, the lease expense must always be amortized on a straight line basis. In this case, it's pretty easy because my rent payments never change. It's going to be $55,000. So I'll show you where that comes from. I basically took all of my rent payments for the period and divided it by the number 48 of payments that I'm making to get $55,000. So my monthly lease expense straight lined is going to be $55,000 per month. And you can see that is in always all of my accounting. So that's my lease expense. My lease liability. So my lease liability is typically going to be my payment less my interest. So the first one, there was no interest, but you can see here, the formula built in is really taking that payment less the interest. My right of use asset, I will come back to for one sec. Then I will go into my credit, which is either going to be my cash or my lease payable. This is the amount that you're actually going to pay per month. In this case, it's a $55,000. And it stays $55,000 because that's consistently what I'm paying under this basic lease. My right of use asset, there's two ways to look at it. In one way, you can say it's basically the plug. So these four entries need to balance to zero. So my right of use asset basically needs to be the plug to balance them to zero. In this case, you can also look at it in this easy example as essentially the lease expense less the interest, kind of reverse sign so that I get the right way. But the easy way to look at it is it's your plug to balance these four. And so now you can see each month I produced what my accounting entries would need to look like each month. To build some checks and balances in here, I have put in this green section what the net balance of my lease liability and right of use asset would look after each accounting entry. And again, they're a little bit formula based to kind of help you out. So you recall up in the purple, my lease liability started out at $2,386,955.48, same as my right of use asset. Then the balance, I'm basically taking my entries, taking the balance from the month before, and I'm adding and reducing based on the entries over here. So in this case, I'm taking this balance and I'm reducing it by my debit to my lease liability, reducing my lease liability. Same here, I'm taking the right of use asset from the prior month and reducing that by the credit to the right of use asset. And as you see, I do that for every month throughout the course. And then I've built in these yellow highlights, which are my checks and balances. So I'm making sure that by the end of the lease, in this case, that December 2025, I have fully amortized my right of use asset and my lease liability. And my total of these entries, which is my lease payable or my cash, actually total the actual payments on the lease. So I have fully balanced everything to zero. My lease liability and right of use assets are fully amortized, and my entries each month balance to zero. One other thing we do produce in the lease, you can see over here is I just kind of noted over here how am I going to record that initial right of use asset in this easy example. They're the same amount. So I'm recording a right of use asset and a lease liability, and they balance. That is scenario one. Now I'm going to go through scenario 1B. With this one, I'm not going to go through all of the details. Sorry if I'm making you dizzy. Because it's very much similar to the scenario one. The scenario 1B, the only difference that I'm going to do here, just to show you how it impacts, is I now have a lease incentive. So all the same factors, all the same payments, same interest rate, start and end, except now I actually have a lease incentive per the contract, which is $200,000. In this case, I had a lease incentive of $200,000 that started on January 1st, 2020. In this particular example, the client has been amortizing that over the course of the lease. So now that I'm 2 years into the lease, that lease incentive is going to be partially amortized. So I will show you what that means. But same terms here. Your input to T value is exactly the same. The lease incentive does not impact the lease liability at all. So all of those inputs are exactly the same. You can see my lease liability calculation here in purple is exactly what it was before, $2,386,955. What does that lease incentive impact? That is going to impact my right of use asset. So again, to calculate my right of use asset in this example, I start with that same lease liability, but now I'm going to reduce it by the $200,000 lease incentive. However, if you recall, I said that lease incentive started back on January of 2020, and the client has amortized 2 years of that lease incentive. So this really represents my 2 years of lease incentive. So my lease incentive on the books at that point is $133,000. So my right of use asset would be less than my lease liability. And you can see here, if you had that lease incentive and you've been amortizing it, this is how I would record my right of use asset, my lease liability, and then I'm removing that lease incentive that maybe was on the books being amortized, because now I'm really capturing it with my right of use asset. So now here, coming down here, you can see in the green, my lease liability is the same as it was before, and my right of use asset is the lower amount, the $2,253,622. So now let's look at how it impacts. You're going to see that the lease expense is going to change, and my right of use asset is going to change. So again, my lease expense needs to be amortized straight line. We keep repeating that. So where am I getting the $52,222? Why is it not $55,000? So I'm going to take you over here to the bottom and show you how I've calculated that. So here's my $2,644,000, and there's my $55,000 that we had before. But now I've got to amortize or expense these this lease incentive on a straight line basis, kind of similar to what they were doing before. I'm just doing it through this accounting ways, through my right of use asset. So I'm taking that $200,000 lease incentive that's already been partially amortized, and I have the $133,333, and now I'm spreading that over the remaining term of the lease. So now my monthly lease expense is going to be $52,222.22. And you can see that amount stays the same all the way through the periods. So that is my lease expense. My lease liability, same process. That process doesn't change. Same calculation. It is simply going to be that lease payment minus the interest. My payment, my cash or my lease payable, again, doesn't change. It's still my $55,000 I'm paying every month. And then my right of use asset, for ease, is that plug to make sure that those entries balance. You can see I built a formula in here, but essentially it's basically balancing those entries. Now you can see here, similar to what I did before, I kind of amortize off that lease liability and the right of use asset, which you can see now at any point in time, is not the same. My lease liability and my right of use asset will not be the same amount in any particular month because I have that lease incentive. But you can see as I get down to the bottom, again, I've built that balance, that check in there, and you can see I fully amortize both my right of use asset and my lease liability back down to zero. My double checks work. So again, to repeat, a lease incentive, what it really does is it affects that right of use asset. It affects that lease expense and it'll affect that right of use asset. That's really, this is the easiest way to show you what that lease incentive does. Scenario 2, now that you're all experts, now we'll get into escalating lease payments. So this scenario, the only thing I've really changed are those fixed base rents. So I still have the same terms up here above, same start, same end, same rate in the lease, no lease incentives to simplify it to show you I've kind of taken that back out. Now you can see my lease payments, they start at a base rent of $50,000, but each year my monthly rent goes up by $2,000. So I'm paying different amounts in each of the years in my monthly amounts. My fixed amounts, so my utilities CAM still remain the same. My total consideration on a per monthly basis goes up by $2,000 per month for each year. So in my inputs, the only thing that's really changed from before is that I now have, my different lease payments. So my payments going up, those 12 monthly amounts, starting at 59 in 2022, 61 in 2023, 63 and 65. Now, when I enter all that and list my loan as unknown, my lease liability is going to be $2,685,070,051. So you can see it's different from the first one. In this particular example, I have no lease incentives or initial direct costs. So I went back to simplifying it. My lease liability and my right of use asset are exactly the same in this case. Now, I put my amortization schedule over here. And you can see, as I noted, my payments go $59,000 each month, 61, 63, 65. Now, keep in mind, when I calculate my lease expense, again, we keep saying this, it needs to be amortized on a straight line basis, same amount over the course of the lease. So now my lease payments are changing, but my lease expense needs to remain the same amount over the course of the lease. So I took my total payments that I'm making over the course of the lease, the $2,976,000, divide that by 48, how many payments I'm making. And you can see my lease expense now, because it needs to be straight line, is going to be $62,000 per month, which will agree at the end after I amortize it. The 2,976 agrees to the amount I'm paying. So coming back up here to the entries, that's where I pulled my lease expense from, straight line basis. My lease liability, again, hasn't changed. It's going to be that payment less the interest. Formula hasn't changed. My cash or my lease payable is going to be what I'm actually paying. So in the first year, it's going to be $59,000 a month. In the second year, it's going to be $61,000 a month. In the third year, $63,000 and so on. And then for ease of calculation, my right of use asset is essentially my plug. We have a formula built in here, but it's essentially what I need to balance these entries to zero. Again, to make sure I've done all the counting correctly, here's my lease liability, my right of use asset. And as you can see in this example, because I have those escalating payments, again, my lease liability and my right of use asset, besides the day that I record it on day one, will not be the same. See how those amounts differ. But again, this template will actually build in the counting for you, taking the initial balance from the month before. And you could see why the balances don't, my right of use asset is going down more particularly than my lease liability throughout here. And it flips a little bit. And then you can see at the end of my lease, I have fully amortized my lease liability and my right of use asset. So I put my checks and balances, made sure everything balanced to zero, made sure all my payments agree to my total payments here. So again, walking through these, I'm going to flip back over, but what I would advise is we can provide you these templates. We can give you these examples. I know I've kind of walked through it, you know, maybe quicker than you would have liked or quicker than you can digest. What I'd say is after the fact, we can provide you the materials, kind of go back through the materials and just kind of digest it a little bit. And if you have questions, feel free to reach out to me. I'm happy to answer any questions at any time. And so those are the template, and that's kind of how we walk through those different scenarios. If you have more complicated scenarios and you need someone to look at it, again, reach out to your accountant or your auditor and see if they're willing to help you. I know at CTBK, we're always willing to kind of go over and give clients some examples or review any of the templates that they put together with them. And we'd be more than happy to do that for you. And before I let Rebecca kick it off with some considerations for related party, I am going to give you the next keyword. So that keyword is going to be Mississippi. Believe it or not, today is National Mississippi Day. And because every time I give that word, my kids love to sing the song and how they spell Mississippi. We're going to see how many people can sing that song in their head as they're writing down this word, and they can put that into the Google form to get your CPE credit. So thank you. And Rebecca, I will turn it over to you.
Thank you, Kristi. So now we're just going to get into the guidance for related party leases. Many related party leases may be month to month or unwritten. So it's really important in these cases to understand whether or not topic 842 is going to apply or not. So although topic 842 only applies to leases extending beyond a 12-month term, having a month-to-month lease does not necessarily mean that the standard won't apply. Evergreen and month-to-month leases may still fall under topic 842 if there are legally enforceable rights that extend beyond a year. So for instance, if a lease is only a 12-month lease, but renews automatically each year and the lessee faces a penalty for terminating the lease, that could indicate legally enforceable rights that mean the lease should be considered long-term for purposes of this standard. So as Kristi mentioned, going through the template, that first step of just really understanding the lease terms and what your lease says is the most significant part of the whole process. Additionally, there may be implied legally enforceable rights, even if there's nothing explicitly stated in the lease agreement. So an example of this could be if a lessee has leasehold improvements, which are being amortized over 5 years. This may indicate that the lessee expects to use the space longer than the next 12 months, in which case the legally enforceable rights may extend longer than 1 year. So the lease could be considered, topic 842 could be considered applicable for that lease. So because of all those different factors, we're going to review the different scenarios that could happen if you have a related party lease on the next slide. So there are a few different scenarios we'll walk through now when it comes to implementing topic 842 for related party leases. The first scenario would be that topic 842 does not apply. So if there are no legally enforceable rights or obligations in the agreement, topic 842 would not apply. One of the more important factors to consider here is whether the lessee and lessor can both terminate the lease without permission from the other without significant penalty. So if this is true, the lease would not be considered enforceable and you would not need to adopt the new standard. So if you review your leases and determine that topic 842 does not apply, no change in accounting treatment for those leases is necessary. And then the second scenario we have on this slide is that topic 842 does apply, and you do a full adoption of the standard for your related party lease, showing a right of use asset and operating lease liability on the balance sheet of the lessee.
And something just to mention before you go on, Rebecca, is there is the AICPA did produce some guidance out there in February of 2022 that kind of gives more information on related party leases and some of the positions of, I'll call it the larger key audit firms. So that might be something to consider.
Thank you. So then here on this slide, we have two scenarios involving adoption of topic 842, but without recording the right of use asset and operating lease liability on the balance sheet. So these scenarios will only apply if you are reporting on a consolidated basis. So the lessee and lessor will both be consolidated in the same set of financial statements. So in these cases, the lessee would adopt topic 842. However, as the asset and liability will both be eliminated in consolidation, nothing will change on the consolidated balance sheet. So the first of these scenarios is that you can opt out of showing consolidating schedules in your financial statements. And as the consolidating schedules are not shown, there's no need to record the entries for topic 842. This scenario will not impact the opinion given during your audit, and it would remain unmodified. The second of these scenarios is that you can continue to include consolidating schedules in your financial statements, but receive a qualification of the opinion on the consolidating schedules only. So in this scenario, you would still receive an unmodified opinion on the financial statements themselves. The only change is the opinion on the supplementary schedules. So there's just quite a few different options to consider when you're choosing an implementation scenario for related party leases. But the starting point is reading through the lease agreements to first determine if a lease is present, then considering the best implementation option for your specific scenario.
Yeah, and another thing just to add is both of these scenarios do have you adopting ASC 842, so you will still have some footnote disclosures on the adoption. So I think that brings us to the end of what we had here to present to you today. Here is our email, both mine and Rebecca's. If you have any questions, we'll get to, I see there's some Q&A. I can't see them, so I'm hopeful that Rebecca or someone can share what those Q&As might be, if it's something that I can answer. But you can always email me after the fact if you have any questions, and I would be happy to address them. And if there's any other topics that you'd like to see us produce a webinar on or give more information on, feel free to either let us know that in the survey or email me directly, and we can do that as well.
Yeah, so we do have a few questions. First one was just about the Google form for the keywords, which will be sent out after this concludes. The second one, in a triple net lease, do you still need to include the taxes, utilities, etc. in the model?
So I'm not familiar with the triple net lease, but I would say if they are fixed payments and you are basically grouping, lease and non-lease components together, they may be considered fixed payments that you would capture them for this particular, for a lease term.
Okay, and then our next question is, many real estate leases have a minimum annual escalator, for example, 2%, or an index change such as CPI. How do you deal with this in calculating the lease liability?
So if this is a variable rent based on an index, you would capture that using the index as of the start of adoption or start of the lease if it's past 1/1/2022. If it's the straight 2%, I believe that you would be able to calculate that still. If it's just a straight 2%, not based on an index, and you can calculate that, then you would be able to use that as well. But if it's based on a CPI or something, or if it's based on something that's not necessarily an index, revenues, for example, I've seen leases based on revenues. I've seen leases based on, input or manufacturing input, stuff like that. Those sorts of variable rents you can't capture in the lease liability. And if you're unsure, you could always ask your accountant or auditors.
And then our last question we have here is how to account for real estate taxes in leases where the lessor passes those costs on as incurred, or also utilities billed directly to the client, and whether or not those should be included in the lease liability or right to use asset.
I would first say, let's look at the lease first. Is it captured in the lease? Does the lease say utilities? Does the lease list an amount for utilities, or is it more general as utilities or taxes? Again, going back to what is written in the lease, typically I think the standard was meant to say if there is a lease amount in the lease, you need to capture that. If it's an unknown or it's based on other factors, maybe real estate taxes that you don't know about because you don't know what those amounts are, those would be variable, not necessarily based on an index or anything you can see. So those would not be captured. So I would say, the conservative thing is to go back to your lease and see if it's captured as an amount in your lease.
That looks like all of our questions, unless anybody else had any last questions as we wrap up.
If not, I want to say thank you to everyone for participating in this. As I mentioned, we will be sending out that Google form or that survey following this presentation to anyone that's registered. If you have more than one person that is sitting with you, kind of watching a similar screen, make sure multiple people fill out that survey so that you can get that CPE credit. Based on those surveys, we will also send out the materials to you. So that's why that's kind of important. Also, hopefully I want to get some feedback on this presentation and any other presentations you think would be helpful. If you don't get either of those, I would say within a couple of days, feel free to reach out to me directly. My email is right there, and I will follow up to make sure that the survey and the materials get sent out to you. And if you have any questions once you get them, please let me know. Thank you.